In Chapter 4, we're going to finish up our study of the accounting system, the accounting cycle. And so everything should start to come together. A couple of things I want to review and reinforce here in Chapter 4. One is revenue and the other is expenses. And we've talked about revenue and expense before, but I want to reinforce it today. So we know that revenue is earned when the performance obligation is satisfied. In other words, when goods and services are provided. And that's mostly how I've been conveying it in class. When goods and services are provided, that is revenue. But another way of looking at it is the company has an obligation to perform some service or to deliver goods. And when they deliver those goods and services, they've satisfied their obligation of whatever the performance is. So we recognize that revenue is going to be recorded when it's actually been earned, when the goods and services are delivered, rather than when cash is received. Now, eventually, cash will be received, but it doesn't always take place at the time of when the goods and services are delivered. So let's look at this. We earn revenue by providing goods and services. In other words, we perform our obligation, or we settle our performance obligation. Either cash is received, or we might have a right to receive cash, which creates an account receivable, or we have a reduction of unearned revenue, and I'll talk about that more here and illustrate it in a little bit. So let's look here at our summary of things. So there's really three possibilities of the timing of when we actually collect our cash. Here, here, or here. So we might have cash is received at the same time that we deliver goods and services. In that case, cash comes in at the time that we provide revenue. So cash gets, when we think about, assets go up with debits, and the other side goes up with credits, and we know that revenue increases retained earnings, so it's a credit. So we debit cash, credit service revenue at that time. Another possibility is that cash is received before the company delivers goods and services. So in that case, cash comes in, but instead of performing the service, we actually have a liability. So cash comes in, and we actually create some sort of liability account, and that liability account is called as unearned revenue. Unearned revenue. So we have revenue accounts, and we have a liability account called unearned revenue. So at that time, we would increase our liability, increase our assets, cash comes in, unearned revenue. Now let's say that and then later, when we provide the services, so that was transaction number one. And then later, when we provide the services, we actually earn our revenue providing the services, and so the liability is going to go down in the second transaction, and then nothing happens on the asset side. Revenues go up, that's our credit. Unearned revenue, the liability goes down, where retained earnings via revenue goes up. Okay? So that's a second possibility. And the third possibility is that we provide services first. So in this case, so here's our accounting equation. We provide the services, so we earn the revenue, but we don't get cash. Instead, we get an asset called accounts receivable. I'm just going to abbreviate it AR. So assets go up, and retained earnings goes up via service revenue. So that's the event that takes place first. And then the second transaction is that we collect our cash. When cash comes in, what we give up is we reduce the customer's account with us, and nothing happens on the other side of the accounting equation. So the second transaction, cash comes in, that's why we debit cash, accounts receivable goes down, so we're going to credit assets to reduce that. Okay, so that is revenue, and so I want to emphasize here, revenue is providing goods and services. Cash can come in at three different times. At the time we deliver the goods and services, before we deliver the goods and services, or after we deliver the goods and services. So 3 timing possibilities for the cash flow. And the same thing's going to take place for expense recognition. Expenses represent costs that have been used or consumed, and the emphasis are past tense. We've already consumed it. And we want to match expenses in the same accounting period with the revenue that has been generated. Because right on the income statement, we report revenues and expenses to arrive at our net income. That's supposed to be an X there. So these are the expenses that generate this revenue. So that's called matching those together. Okay, so it can be a cause and effect. These expenses cause this revenue. It can also be a passage of time. And we'll see that, with interest expense is caused, time has gone by and we've incurred the interest. Okay, so transaction, we incur expenses, we either are using up assets or we're using up services. And either cash is paid right away, or we have an obligation to pay later, which creates a liability, a payable, or we have a reduction of prepaid expense. So let's go through these. Let's say that cash is paid in the same period the expense is incurred. So in that case, right, cash goes out. We know that expenses reduce retained earnings, and so we have some sort of business expense. So again, remember, assets go down with credits. Retained earnings goes down with debits. And so we see we are debiting a business expense and crediting cash. Expenses again reduce retained earnings. Cash is credited, causing assets to go down. Another possibility is cash is paid ahead of time before we actually use whatever it is. So in that case, we actually will have some sort of asset, and that is some sort of prepaid item. Some sort of prepaid, and this is just called a prepaid expense. Usually it's either rent gets prepaid, it could be insurance. I'm just going to abbreviate insurance, INS. So typical expenses that get prepaid are rent. You prepay your rent, you pay your rent ahead of time, you pay insurance ahead of time before it actually expires, right? So in this case, the asset comes in, cash is given up. And then I just assign my debit credit rules. We know assets go down with credits. That's why cash is credited. Assets go up with debits. That's why prepaid expense is debited. So that's the first transaction. And then the second transaction in that situation is that we either use the rent or we use the insurance. So in that case, retained earnings will go down because we have consumed the rent or we have consumed the insurance. We use the costs that we've already paid for. And then this asset, I'm just going to abbreviate it, PP for prepaid. Prepaid rent or prepaid insurance, whatever it is, will go down. The asset will go down. So assets go down, retained earnings goes down here. And so what I'll see, my debit, this side goes down with debits. So I'm debiting business expense. Oh, excuse me, I'm over here. Sorry about that. I debit business expense that causes retained earnings to go down. And I'm reducing my asset because we have now consumed that cost. Okay, the third possibility is paying for the expense after I've used it. That's often a good example of that would be like utilities. So in this case, I first use it, so retained earnings will go down because I have consumed it. I haven't paid for it yet, so if I've got my assets, liabilities, and stockholders' equity here, then I'm going to create some sort of payable. I'm just going to spell it out. And then nothing happens on the asset side. So again, we have retained earnings going down because, in this case, a business expense, and then a liability going up. So we know that this side goes up with credits, this side goes down with debits. So my debit is to the expense. So in this case, I first debit my expense to reduce retained earnings, and then I increase my liability by crediting, in this case, they're crediting accounts payable. That's the first transaction. And then secondly, so they've consumed, let's say they consumed the utilities, and now they owe money for it, so they have a payable. Now they're going to pay their utility bill. So when they pay their utility bill, cash goes out, and what I get in exchange is a reduction of my liability, right? The utility company will reduce my account payable with them. Assign my debit and credit. This side goes down with debits. This side goes down with credits. And so I'm reducing my liability by debiting it. I reduce cash, and the assets go down. So again, 3 tiny possibilities when the cash occurs. So expenses can be used at the same time we pay cash. Sometimes, like with rent and insurance, we pay for those costs ahead of time and then consume the cost, the rent or the insurance. The third possibility is that we first consume the cost, like we use the utilities, and then we pay for it later. Okay, another topic that we're going to see in Chapter 4. In Chapter 3, we saw that transactions take place. And I also talked about the matching principle. So we want to be able to measure revenues and expenses for whatever time period is, a time period we have. So I have year 1, 2, and 3. It could be weeks, 1, 2, 3, 4. It could be month, 1, 2, 3, 4. I've chose years. But each year we want to start right at 0 and measure, what are our revenues and expenses growing to? How big are they getting? So we want to be able to measure revenue and expenses year after year, counting period after accounting period, and be able to determine, right, the difference is our profit or our net income. Okay, so what's going to happen is that we can see, because there's timing differences between when the revenue and expenses take place and the cash payment of them, that there will be times when we actually need to adjust for revenue and expenses so that we fully measure them 365 days. We don't want an income statement that has 300 days of revenue and 365 days of expenses, right? We need to fully measure revenue against expenses. There should be a full 365 days of revenue, a full 365 days of expenses. Okay, well, adjusting entries, a couple of them, we have deferrals and accruals. Deferrals are created because the cash transaction takes place before the revenue expense does. Accruals take place because revenue expense are incurred before the cash flow occurs. So, and I'll give you examples of that in our demo problem. Our demonstration problem that I'm going to use is problem 3. I've got it here. We are assuming this is the first month of operations and we're at the end of the month. So what you did in Chapter 3, right, you made all those journal entries, you posted to the ledger, and you had a trial balance. We have to assume all of that has taken place, and we already have a trial balance. By the way, I left some blanks because we're going to create some new accounts here at the end of May. But we can see we are in balance, our debits and credits equal. All the activity has taken place, but now it's at the end of the month. Okay, now, if I just look at this, I might recognize some accounts that maybe some of these assets have been used during the month. So here are supplies that we purchased during the month of May. Well, probably by the end of May, we've used some of those supplies, right? So kind of take a quick peek. You might stop your recording and see if you can identify which ones would you actually think need adjusting. Okay, let's look at this. So supplies with prepaid insurance, that's the insurance we've paid in advance. It's likely we have used some of that. This unearned rent revenue, remember, it's a liability because customers have paid in advance. Likely we have provided some of that service and have earned that revenue. So we can easily see three accounts that likely either expenses have been used or revenue has been earned. Okay, so we're going to be, so essentially, we're here was May 1, and we're here at May 31st. All the transactions have been recorded, but we are going to make adjusting journal entries. So we want adjusting entries at May 31st. So we're going to adjust to record additional revenue and expense accounts, and expenses, not expense accounts, expenses here at the end of the month. Okay, these balances I've got in the trial balance. I also want to show you, that's our problem solving. So I've set up some worksheets for us to figure some things out. Here's our journal where we'll record those. Here's our ledger. So those balances from the trial balance, remember on all of our accounts, debits are always on the left, credits are on the right. I didn't put DRCR in each account. I'm hoping by now you kind of have that down, but if not, perhaps you want to put, DR, CR, debit, credit in each of your accounts. If you do, just stop the recording and do that. I also want to remind us of our debit credit rules. So assets go up with debits, so let's make a little note of that. And then liabilities go up with credits. And so here are our liabilities that we're aware of so far. And stockholders' equity, that goes up with credits. And it's the first month, so there aren't any retained earnings yet. We also know that revenues increase retained earnings, so those are credits. Whereas expenses reduce retained earnings, so those are debits. So as expense increases, as expense goes up, retained earnings will go down. That's why these are debits. And of course, when we get to a dividend, if we had a dividend, I don't think we do, DIV, that's supposed to be a V, that would be a debit. Okay, let's go back to our information. So I'm going to actually do 1, 2, 3, and 5. I'm going to separate out 4 and 6 and do them last. Okay? Okay, so insurance expires at a rate of $450 a month. So let's go to our prepaid insurance account. We can see there's $1,800 in that account. So remember, assets go up with debits. And that we can see, I'm just problem solving here. Notice I'm problem solving, and actually we're going to talk about how these are deferrals. So I'm going to show at the end of May, there's $1,800 in this account. Now, it also tells us $450 has expired. So that means, right, that we have consumed $450 of the insurance. So what's going to happen really, if I think of it in the big scheme of things, assets equal liabilities plus stockholders' equity. By the way, I just put this here here's our debit credit rules as a reminder. So what's going to happen is retained earnings is going to go down, right, for insurance expense. And the other side of it is that we've consumed the asset, prepaid insurance. I'm just going to put PP for prepaid insurance. So we want to journalize this. Okay, so let's assign, right, this side goes down with debits, this side goes down with credits. So what we want to do, we know that insurance expense, those are debits. So what we want to do is move $450 over here and reduce this account $450. So when it's all said and done, right, this is a positive minus this negative, we will have a balance at the end of May of $1,350. So our adjusted balance, the adjusted balance at the end of the month would be $1,350. Okay, this is our adjusting journal entry. There's our debit, there's our credit. Let's go make it in the journal. So we want to debit insurance expense. Just going to abbreviate that. That causes retained earnings to go down. 450, debits go first. Remember, when I make a journal entry, and then the credit goes next. Prepaid insurance. Just going to abbreviate insurance, INS. And that's my credit. My debits equal my credits, and then my horizontal model, assets go down, retained earnings goes down, the other side goes down. Okay, and we could even go post that if we want. I don't think we have an insurance expense account here, so I'm going to need to set that up. So at May 31st, I have an adjusting journal entry, debiting this, 450, debit at 450. We credited prepaid insurance, 450, on May 31st. I'm going to go ahead and figure out the ending balance will be $1,350 for prepaid insurance. Okay, second transaction, supplies. We purchased $2,600 of supplies, and they tell us that at the end of May, they had somebody count the supplies, and really there's only 1,050. So if there's only 1,050 of supplies, that's what we ought to be showing on our balance sheet. So let's report. So we know there was a balance at the end of May, after all the transactions have been recorded, we have a balance of $2,600. It's the end of May, and we want to go in. They have told us the real balance, the real amount of supplies on hand is 1,050. Really, there's only 1,050. Remember, supplies expense goes up with the debit. So to get this to balance, I can problem solve. 2,600 minus what gives me 1,050. Well, 1,550. So I know I need to credit supplies, right? I need to reduce supplies 1,550 to get this to balance. And what's the other side? Well, the other side is supplies expense. It's the same thing here. We need to reduce retained earnings for an expense, and we need to reduce an asset because it no longer has that original cost. Okay, here's our debit, here's our credit. Let's go to our journal and make, at May 31st, our adjusting journal entry. So we have supplies expense. Just going to abbreviate it, which causes retained earnings to go down. 1,550. And then our assets, supplies, also goes down. Okay, so debit supplies expense, credit the asset supplies. Notice we have two supplies accounts. Supplies, which is the asset, supplies expense, which reduces retained earnings. Okay, let's go ahead and post that as well so we can see how that's going to, so we can see how that will all turn out. Okay, we do not have a supplies expense account, so we create one. And then on May 31st, I'm going to post the $1,550 debit. And then I'm going to go to the supplies account and post the credit, $1,550. Again, May 31st. Draw my line. Debits are positives, credits we subtract. So 2,600 minus 1,550 will give me an ending balance of 1,050. I'm going to double line that on my balance, BAL. So I write BAL for balance there as well. Okay, so we now have two asset accounts adjusted to what really represents what we have for those assets. Okay, and those really are deferrals, where cash is paid first, the expense occurs later. Right? Cash occurred first, and then we adjusted for the expense as it was consumed. Okay, the next deferral I want to show you is depreciation, and it's a little more complicated. They tell us the annual depreciation on the building and the equipment. So we have the building, right, cost $70,000, and they bought equipment worth $16,800. So let's go to our problem-solving page and kind of look at what we've got going on over here. Again, buildings go up with debits. And we have a debit balance here of $70,000. Now, you saw in Chapter 3 when you did your financial statements that we actually have a contra asset account called accumulated depreciation. So again, accumulated depreciation is a contra asset, meaning it's a negative asset. That's why it's going to go up with credits. So it's a negative asset account. It's actually going to be listed under assets, but it's a contra asset. It's a negative asset. So what we're going to see on the balance sheet for the building, if you recall, what you did on your balance sheet is you would show like the building. I'm just going to abbreviate building. We're going to have $70,000 here. Sorry about that. Let me do that again. And then we are going to net that against this accumulated depreciation. And I'm just going to abbreviate it because it's a really long word, or a really long account name. Accumulated depreciation for the building. And we will net that together, and then we'll get a number that we will call book value. And it's called book value. That's really the accounting value. It's called book value because a long time ago, the accounting records were physical books. So instead of saying accounting value, they said, well, book value. But again, it's an old phrase because, again, accounting records were physical books. Okay, so, well, how much depreciation really for this month? Well, they tell us that for the building, the annual depreciation is $3,600. Well, let's divide. We only need 1 month, so divide by 12 months. SPT. And we'll get $300 monthly depreciation. So again, we're going to see the same thing. We want retained earnings to go down for the expense. So we're going to debit depreciation. So just like we debited some expense over here to cause retained earnings to go down, we want assets to go down, so we're going to credit some account. It's just that instead of the building account, we're going to credit its accumulated depreciation account. Okay, so what's going to happen then is that we'll end up with these two balances, and we'll have accumulated depreciation of $300. So $70,000 minus this contra account, or contra asset, will give us an accounting book value is $69,700. And the whole idea is that then the accountant will always report the original historical cost of these long-term assets, that we originally paid $70,000. Here's how much we have theoretically consumed. Obviously, the building doesn't go away, so it's a conceptual concept of how much cost has been used up, and we have this accounting book value. Okay, we have our debit and credit down here. Let's go over and make our journal entry. Okay, so on 3, we're going to debit depreciation expense. That will cause retained earnings to go down, $300. And then we will credit accumulated depreciation for the building. That's a contra asset. Credits cause assets to go down. All right, let's go post that. We don't have a depreciation expense account, so we'll set it up. And so on 531, I'm posting a debit of $300. I don't have the accumulated depreciation account. I'm just going to abbreviate it because it's such a long account name. Accumulated depreciation building. Remember, it's a contra asset, so it's got the opposite. It goes up with credits. I'm going to post my $300 credit there. So I have a debit to depreciation expense, credit to accumulated depreciation building. Okay, also in that problem, that was the building. We also need to do the $3,000 on the equipment. So here's the building. Turn your page one more time, and we have our equipment. From our trial balance, we know that the cost or the balance in the equipment account is $16,800. We were also told the annual depreciation is $3,000. Divide by 12 months. I'm just going to do MO. And we will get our monthly depreciation to be $250. So for the equipment, its monthly depreciation is going to be $250. So just like we did before, we want retained earnings to go down for the expense, so we debit that. And then assets will go down with the credit. And the credit will go to this accumulated depreciation account. Again, it's a negative asset, so it's flip-flopped. It'll go up with credits. But by crediting it, we cause assets to go down. Okay, here's our journal entry. Let's go record it. So we'll have depreciation expense. Expenses cause retained earnings to go down. It's $250. And then our credit is to accumulated depreciation, but this time it's a different accumulated depreciation account. It's actually for the equipment. Accumulated depreciation equipment. So ACCDEP and then equipment. Okay, so we debit depreciation expense, credit accumulated depreciation equipment. Let's go post that. So debit depreciation expense, $250, so $531. So debit that. We need to create our accumulated depreciation or equipment account. And again, it's a contra asset, so a new thing here in Chapter 4. And we'll post our credit. 531. Okay, so we debit depreciation expense, credit accumulated depreciation, equipment. And let's go post that. Oh, sorry, what am I thinking? We just did. How silly of me. Sorry about that. Okay, and then I want to jump forward. I'm going to skip forward. Let's go to number 5. Unearned rent of $2,500 has been earned. So we have this unearned rent revenue account of $3,300. So let's go and problem solve. Again, we're doing deferrals right now. So where the cash part has already happened, notice in all of these we're recognizing either expenses so far, and now we're going to see a deferred revenue. Okay, unearned revenue is a liability, right? So it's a liability account. So let's make a note of that because a lot of times students forget it's a liability. So liabilities go up with credits, and there is a balance of $3,300 in this account. At the end of May, after all the May transactions, it has an ending balance of $3,300. And then they just told us that $2,500 has been earned. So time has gone by. They have provided rent, whatever it was, this facility, allowing customers to use it, and they've earned $2,500. So essentially, right, they have earned revenue of $2,500, and they need to reduce their liability, right, of $2,500, and nothing will happen on the asset side. So we need, revenues go up with credits. So we're going to credit revenue $2,500. Liabilities go down with debits. So we'll debit the liability $2,500, causing liabilities to go down. Extend that portion of the line. So then this is a positive, $3,300 minus $2,500. Our unearned rent revenue at the end will be $800. So we still have $800 of rent to provide at the end of May. Okay, here's our debit, here's our credit. Let's go make a journal entry. Okay, so we want to not me. That's number 5, isn't it? So number 5 is unearned rent revenue. I'm going to abbreviate it REV, but it's rent revenue. Unearned rent revenue that causes liabilities to go down. That was $2,500. And then we have provided that service, so we have earned rent revenue. Revenues cause retained earnings to go up. Okay, so liabilities go down, retained earnings goes up, nothing happens to assets. Let's go post this. Okay, so our debit was to credit unearned rent revenue, $2,500 here on May 31st. I'm going to go ahead and draw my line. $3,300 minus $2,500 gives us an ending balance of $800. And then, so we debit $2,500, and we're going to go to rent revenue and credit it $2,500 on May 31st. So debit, credit. Okay, those are all deferrals. So notice we had a journal entry impacting expenses and revenue because either cash had already been received for, like in this case, unearned rent revenue, or cash had already been paid out for these assets. Right? Cash had already been paid out for these assets. Okay, now let's go to accruals. Accruals, no cash has been paid yet or received. So on number 5, the mortgage. We have a mortgage of $3,600. Well, a month has gone by, right? That was taken out on May 1. Well, interest accrues, right? So they tell us we have a 6% interest rate. So let's go problem solve. Notice how I am problem solving for the adjusting entry. So you will need to set up, you notice how I use these T accounts to help me problem solve. You'll want to do likewise. Mortgage payable is a liability. Liabilities, right, go up with credits, so their normal balances are credits. So we have a $36,000 balance in mortgage payable. Now, we know the formula for interest. You probably already know this from lower levels of school. Sorry about that. Got ahead of myself. Is principal times rate times time. Principal times rate times time. So they borrowed $36,000. That's principal. They borrowed at a 6% rate. And then time. Sometimes students want to stop here. This is an annual percentage. Oh, sorry, I keep wanting to write a P as an R for some reason today. This is an annual percentage rate. That's typically how interest rates are quoted on an annual basis. Since this is annual, I need to state time in terms of a year. So I'm just going to do 112. In the real world, it would be so many days out of 365. So $36,000 at an annual interest rate of 6% for 1 month is $180. Okay, so if I put it into my accounting equation, we know that retained earnings is actually going to go down because we have incurred interest expense, right? Time's gone by, we've consumed this $180. But we haven't paid for it yet. So we need to increase some sort of liability account for 180. Oh, that should be retained earnings. Sorry about that. So retained earnings goes down for interest expense. A liability is going to go up because we owe the 180 to the bank. Okay, sign my debit and credit. This side goes down with debits. It goes up with credits. So I'm going to debit interest expense 180, credit interest payable 180. So now I'll have a balance of interest expense of 180, and that creates an additional liability of 180. Okay, let's go journalize that. So that was number 4. So let's debit interest expense. Causing retained earnings to go down. And credit our liability, interest payable. Which causes liabilities to go up. So debits equal credits, liabilities go up while retained earnings goes down, nothing happens to assets, and we're in balance. Let's go post that. We don't have an interest expense, so notice I have assets, liabilities, and stockholders' equity. I'm just going to extend, my expenses over to here. So let's create interest expense. Goes up with debits. And so we have a debit of 180 on 5/31. Debit that, go up to my liabilities. I need to create an interest payable. And post my credit of 180. So I have a debit of 180, a credit of 180. All right, finally, last one. So our last one is also an accrual. So salaries of 900 are accrued and unpaid. So it's accrued, meaning we haven't, well, obviously it tells us it's unpaid. So we owe salaries. So let's go problem solve with our T accounts so we can envision it. So we know retained earnings needs to go down because we have incurred salary expense, right? And we haven't paid for it, so we need to increase some sort of liability. And nothing will happen on the asset side. So we know this side goes down with debits, and it go up with credits. Oh, I needed to make a point. We already had a balance in salaries and wages of $3,000, so let's put that in there. So we already had this $3,000, and now we have an additional $900 of salaries that haven't been paid. So I'm going to debit salary expense and credit wages payable. Okay. There was no balance in wages payable. Okay, so now we know our debit and our credit. Whoop. Let's go record it. So salaries and wage expense. Again, expenses reduce retained earnings. Debit at 900. And we want to increase the salary and wage. I'm just going to do S&W for salaries and wages payable. And that's a liability. So debits and credits equal, liabilities go up while retained earnings goes down. So salaries and wages payable. Okay, let's go post that. Here's our salary and wage expense on 5/31. We're going to add another $900 debit. I don't have a salary and wage payable account here. So let's add it. I'm just going to do PAY, don't have much more room, and post my credit. So I debit salary and wage expense 900, credit this 900. Okay, so we have adjusted. We've adjusted for deferrals. We have just adjusted for accruals. So now all our revenues and expenses represent, a full 31 days for the month of May. The next thing we want to do is figure out our ending balances. Notice we didn't adjust cash, so it stays at the same. We've already done supplies and prepaid, lands and buildings. This accumulated will be $3,000. Same thing with this accumulated depreciation account. That balance doesn't change. I've already updated that one. Here's our balance, here's our balance, here's our balance. That's all up. I need to do revenue. 9,000 minus 2,500 will give us an ending balance of 11,500. Okay, and then also salary and wage expense will have an ending balance of 3,900. And then all of these depreciation, since there's two, I need to add that together to get an ending balance of 550. Okay, then the next thing we want to do is to write these balances out on our trial balance. So let's start with the assets. So just remember 2,500, 1,050, and 1,350. So let's go back way back. Okay, so here's before adjusting entries. After adjusting entries, cash stayed at $2,500, but supplies actually went down to 1,050. I'm just pulling from my T accounts, and prepaid insurance now is 1,350. So I'm just copying over my balances from my T accounts. By the way, I know land stayed at 15,000 and building stayed at 70. Let's go take a double peek on that. Yes, land and building stayed the same. Then we have these accumulated depreciation accounts, 300 and 250. I need to add those in. So we're going to have, I'm just going to abbreviate it, accumulated depreciation for the building. And that was a credit, had a credit balance of 300. By the way, equipment didn't change. But we had accumulated depreciation for equipment. And that was a credit of 250. So we have these two contra assets, 300 and 250. Okay, now we're ready for our liabilities. Accounts payable, 4,700, 800, 180, 900, and 36,000. I'm just going to go put all of those in. So accounts payable, now it stayed at 4,700. However, unearned rent now is a credit of 800. We have interest payable. With a credit of 180. And then we've had salaries and wages payable. I'm just going to abbreviate it, PA, well, I'll just do payable. And that was 900. And then the mortgage stayed at 36,000. Okay, so I enter in all of those liabilities. Common stocks at 60, nothing in retained earnings, revenues 11.5. So let's go put in those credits. So common stock stayed at 60,000. We still don't have anything in retained earnings. And rent revenue now is 11,500. Okay, they had already listed salary. So let's go to our expenses. Oh, I went the wrong way. Sorry about that. Okay, and I'm going to enter in 39.85, all of these. Okay, so let me go just enter those in. Salary and wage expense, these are debits, now is 3,900. Utilities expense stayed at 800. Advertising expense stayed at 500. Let's go ahead and put interest expense. Of 180. It was insurance expense. I'm just kind of trying to recall off the top of my head. There was insurance expense. There was supplies expense. Again, just off the top of my head. Insurance expense was $450. Supplies was $1,550. So interest expense was $180. Insurance expense is $450. Supplies expense is $1,550. And then we also had the depreciation expense. Of $550. Okay, so I've listed all my debits, all my credits. Add them up. You should get $114,630 on the debit side. Add up all the credits. Oops, sorry, again, I'm adding those up. So I'm drawing my line. Add that up. $114,630. So now I have my finished adjusted trial balance. And from here, we would write out our financial statements. So, right, here's all my revenue and expenses. I would write out my income statement from that. And then I can do my retained earnings statement. And of course, notice I'm not including retained earnings in anything. But here would be my balance sheet accounts. But these are the numbers that we would use. Okay, I'm going to stop here. I've got something else to tell you, so don't stop listening to this. But I'm going to stop the demo problem here, and we'll do the financial statements together in class in our next class period. I do want to talk to you about your assignment in Wiley Plus. Okay. You're going to do this comprehensive accounting cycle problem. It is the whole accounting cycle. So notice part A, you have transactions for the month of March. So this is like you did in Chapter 3. You're just making journal entries. So journalize the March transactions. So you'll go through and do all of that. Okay, and then I fast forwarded. Here we are in part B. It asks you to post. Do not do this. I assigned no points. Well, actually, I couldn't give it 0. I had to give it 0.01, but essentially it's 0 points for doing the posting. So when you get to part B, just hit submit 3 times so that Wiley Plus will do the posting for you. You really will not lose any points. I just want to make this problem faster for you. So the posting is tedious, it's time-consuming, it's prone to error. So I thought we would bypass that. You've got to practice posting in Chapter 3. Let's not repeat it again in this particular assignment. So for Part B, and then also when you get to Part E, this is posting the regular transactions. Part E is posting the adjusting journal entries. So when you have to post in B and E, just skip it. Hit submit 3 times. Let Wiley Plus do the posting. You will not lose any points. By the way, you are not doing this entire problem. You just do A through G. So if you look at your assignment sheet, I only want you to do A through G, but make sure you get this done because we're going to go over how to finish it up. We'll look at closing entries and that sort of thing on Tuesday's class. Okay? All right. Good luck to you. Bye.